Welcome back to another episode of RecTalk. I'm your host, Nitin Sharma, the founder of RecTools.io. For those of you who don't know, RecTools is the largest whole-of-market directory within the recruitment supply chain. If you're looking for a new supplier for your business, be it a CRM provider, be it a new website provider, be it some payroll companies, maybe you need to do some ID and V checks, maybe you need to find a business that's going to help you with your outsourced marketing, head over to RecTools.io. It's a whole-of-market directory and it's free to access, so fill your boots. If you're a supplier into the recruitment supply chain and you're not on RecTools.io, just drop me a note. Let's get you listed. We have free listings available and we're driving traffic to the site all the time. That's enough from the intro point of view. Let's get straight to it. The podcast today features someone who's turning into quite a good friend of mine and I've got a lot of time for. He has officially, as of today, but this will be coming out in 5 weeks' time, so you'll long know about this by then, but officially as of today, has come on board to RecTools as our fractional CFO. And here to talk about kind of the recruitment industry's finance needs and the trends and issues that we're finding in that marketplace today is Scott Kirby, qualified accountant, right?
Yeah, qualified when I was 20, 16 years later after my birthday yesterday.
Hey, there you go.
It's, I've been in the recruitment sector for 10, 12 years, dabbled between recruitment agencies and kind of recruitment tech products. And it's still one of those industries that amazes you each and every day, isn't it? I think that's the challenge, is the market's constantly changing. Mm-hmm. The challenges that face the industry through 2021 and into 22, obviously coming back into 23, where the market's not the same as what it was. It's now, when we look at where we are and what businesses are facing today, it's crazy.
So what is the trends that you're seeing? Because I know we spoke a lot off camera today about sort of some of the stuff that you're kind of involved with and helping with at the minute, which is great to see. But what's the overall trend at the moment that you're seeing?
So I think there's a lot of recruitment businesses that are struggling. Mm-hmm. There are a lot of companies where they've had some good times through the kind of the bounce back from COVID. There's been a lot of cheap money out there in terms to support people grow. And kind of towards the end of last year and into this year, the market's become a lot tougher. There's a lot more layoffs and you've got a large cost base you've got to surface. Mm-hmm. And the number of companies looking at restructuring is massive, because they took on things that now they can't in reality afford to repay. And it's not about growth and kind of, it's not necessarily about growth anymore, it's really about survival. Yeah. And can you get through to the next stage of the cycle, the growth cycle? Because the market has got a lot tougher. There's still so many new businesses setting up, which makes the industry ever more competitive.
It's more diluted every time it happens, right?
Yeah. And like, how do you stand out apart from that? If you're a much larger business, mm-hmm. you've got a much larger cost base, you lose some of your top billers because they go up and set on their own. They take half or they don't take, but they kind of end up working with clients in the same space. That has a massively kind of dilutive impact on mm-hmm. not just the overall value, but kind of the survival of some of these larger businesses.
It's funny how much the impact of kind of the cheap lending that was made available, things like the VBLs, the RLS and the CBILs. I know I've got a few different kind of brokers and introducers within that finance space that I speak to. And general sort of feedback seems to be that they didn't fix the problem that they were meant to fix, and unfortunately have created an entirely new problem, which is, as you said, we as recruitment business owners, we're not very good at cash flow forecasting. We're not very good at management accounts. We don't know these things because we're good salespeople. We're great recruiters, but we're not as finance people, right? But then we create and go and set up these businesses that rely on us to be kind of all things to all people. Yeah. We tend to have, generally speaking, quite transactional relationships with our accountants in the quarter end, do my VAT bill, do my corporation tax bill, do my personal tax bill, maybe do the payroll for my team, that kind of thing. And so it leaves a big gulf of kind of like knowledge and expertise, right? And then you find that those same people are then making decisions with the right intentions, but not necessarily the right decisions.
Yeah, because you usually have the wrong information. And I think that one of the standout things you talk to more and more people is that even with the small startup kind of recruitment community of where maybe you've got 5 or 6 people in a business, or maybe 8 or 9, how many of those actually remember or go back to the basics of how much revenue they need to drive each month just to cover their cost and break even? Because kind of the equivalent of all the government support schemes, the C-bills, the bounce back loans, and lots of government supported lending, which was cheap then, but obviously interest rates have moved massively upwards since, and it's kind of like that equivalent of everyone who goes out and gets a 0% credit card.
Yeah,
it's great. You've got this new credit card that you can spend as much as you want on, almost interest free, and then you come into the end of that cycle. And where we're now is all these businesses that kind of have access to all this capital. It's now the fact of when the interest starts to bite and they can't refinance it, or the funding itself is unsustainable in terms of the cost on the business. And you look at that in the wider economic cycle of kind of the number of insolvencies that are kind of going through in the market.
Well, the report was year on year they've increased for the last 3 years, and at the moment they're at an all-time high within the recruitment industry alone, let alone kind of wider businesses. So what's the solution to this then? What's the kind of magic wand fix?
Well, the key thing is really taking a cold, hard look at your business. If you're not making money, then the reality is something's got to change, and not the traditional recruiter mindset of we'll just bill more. Usually you've got into a stage where the business is unsustainable in its current guise, and there has to be a round of kind of cost cutting to get back to a point of where, as quickly as possible, you can be kind of cash flow positive. And one of the key things...
What's the appetite to supporting from the kind of the big banks and the mainstream lenders that are out there? What's the appetite right now for them to support you through that sort of restructuring model?
So it all depends on kind of the position of the business. If you're a larger business and you've got some equity in the company, then obviously it's easier to a certain degree, but still, because most recruitment businesses their asset base is fundamentally their trade debtor book, which most recruitment businesses then will have assigned that to a lender in terms for working capital anyway. There's not a lot else. So in terms of the days of when you'll get a lot of additional unsecured lending, although that being case, there is obviously unsecured lending out there, but it comes at a premium and with a lot of personal kind of guarantees attached to it. But that likelihood you're going to go to your high street bank and go, do you know what, we're going to run out of money in 3 months' time, and
do this.
They're going to write you a check for 3 months' wage bill to give you time. It's very few and far between. But the key thing with all of these is the kind of the structure and the detail of the information you've got. So you may say you've got a business that's doing this and you're making changes, and this is why we've gone through this journey, but can you actually demonstrate and support that? Because it's like conversations I have regularly is we need to raise more funding. But when you actually drill through the reason of why they need the funding, the story is usually very different to what the data show.
Yeah.
And lenders like something they can kind of come back to and go, okay, they've done this, it's now kind of coming back in the right direction, so why wouldn't we lend them or kind of give them a little bit more grace and flexibility to get through that process? There's a lot of naivety still, though.
Yeah, but do you know, I think fundamentally it comes from a lack of understanding, right? Because I used to say this before, kind of when I ran the recruitment agency, is that most people, we're taught to run our personal finances in a particular way, right? You know, pay off your debt, pay the highest interest first, you know, use 0% credit cards if you need to, and so on and so forth. But like leverage kind of deals and stuff that are out there. But by and large, it's, you know, if I'm trying to secure a mortgage, then I'm going to tell them the things that I think they want to hear for me to secure that mortgage, right?
Yeah.
And generally speaking, the relationship is from the mortgage company, or the mortgage underwriter's perspective is, tell me what I need to hear to be able to press the button to issue the mortgage, because, you know, that seems to be the kind of personal finance world. But business finance is completely different. And I learned this very early on, in that actually, if your business is struggling, trying to hide the fact that it's struggling to a lender is not the right thing to do.
No.
If you've made fundamental mistakes in kind of the day-to-day running, or kind of a bad investment or a handful of bad trades that you've done, and you choose to hide that doesn't bode in your favour, because you're not tricking a system. Like, business lending is still done very much on kind of personal and relationship-based decision-making, because it is so unregulated still, right? Whereas personal lending is literally a computer says yes, computer says no, based on lending criteria. And I think not enough people know the difference between the two, because then that's where you then find people like like my former business partner who'd be able to paint a wonderful picture of what's happened, and then we would get thrown back from the from the loan provider of like, so why do you need the money then? If everything's that great and rosy, what the fuck are you asking me for money for?
But it's so common, that trait of where more and more people will talk about the fact that you don't need it. And it's the business doing great. And I've had this recently of where you look at a prospect and it's like, oh, we just want to refinance our kind of IF line.
Yeah, just fancy.
And then you
it.
kind of, and then you kind of go, okay, fine, like that's an easy enough thing. Like, here's a panel of different providers that can support that. But let's look at your MI. And you start going through the management. Okay, so you're making a record profit, supposedly, and yet you're not generating cash. So what's the problem? Oh, well, and then they go quiet. Mm-hmm. That's actually what happens. You get this period of time between the reality of where it is and kind of, okay, what can we share? And then they'll either not say anything more because they'll kind of go, okay, we'll just carry on as we are. It's not as easy as it used to be to raise money, and we move forward. Or it will be a blind panic of, we're about to run out of money, what are we going to do about it, and how can you kind of fix it?
The honesty comes almost too late in the process.
The honesty comes too late because it's like anything. Like the difference with lenders, investors, any kind of type of financial decision is you only get one chance to kind of lay out your story. If you go with one set of numbers, you start drilling through it, and every question that comes back you can't answer, or it doesn't make sense in the context of it, you're never going to get through credit committee.
No.
Because that's the thing, is you'll have a relationship manager who will write a report. That report then gets submitted to a credit committee. The credit committee make a decision or a kind of a recommendation. Then it will go to underwriting for final kind of approval before it comes back as a bound offer. And all those steps are opportunities of where there are different people that will make different questions. And at any stage, they can kind of go, no, we're not doing that. And the difference between survival and failure in some cases can be so small. Mm-hmm. Because so many recruitment businesses over the last 2-3 years have kind of enjoyed the good times that have come after COVID, taken all the profit out of the company, which is kind of traditional for recruitment businesses. But then when it's coming back the other round and you sit down and you look at someone and you go like, okay, so what are you prepared to put back in on the table? And they go, well, nothing. Like, I haven't got it, because we all know a lot of recruitment owners that like to enjoy.
Well, that's what we go to work for, right? Yeah. But
that difference between actually a well-structured, well-thought-through kind of set of accounts, right commentary, the description of the journey the business is going on and being on, versus just a number and, okay, go and see what you can do, is massive. And you can have the same data presented in two separate ways. One will get funded and one won't. Just because it's really the analysis and the rationale that's given to a prospect that helps it get through that process. And that's kind of where our kind of role sits, is kind of how can we make this tell the right story, but also a story that's credible and kind of backable. Yeah. Because if the business is struggling and failing, that doesn't really matter. It's just not going to get funded.
It's a complicated world though, because again, you've got brokers and introducers of all different ilks, right? You've got some that are like yourself, qualified financial accountants who can, effectively look at a set of management accounts and financial data of your business and push back and, well, what happened here, why did that happen? And, and sort of challenge and try and put into place some financial controls to prevent these things happening again. And then on the other end of the spectrum, you've got the ones that will go, they're very good at marketing or they're very good at sales. They will bid for all the keywords on Google, and they will put through a volume-based approach of just grab a ton of inquiries. Here's the things that I need to ask you for. I'm not even going to look at them. I couldn't even tell you what they're supposed to look like. And I'm going to throw them over to my panel of lenders. And then, generally speaking, come back to you with an IWACA loan or a funding circle loan, right? Because they've not got the depth in relationship or understanding or support that they can offer.
It's just it's kind of that thing of it's a quick fix, isn't it? Yeah. It's the difference between, like, I think ironically, like, our website doesn't even work. It's not fully functional because it's not relevant. It's really a point of reference about what we stand for and kind of what we can do. And most of our kind of introductions are through a personal network or kind of personal connections, of where it's not just, I want to capture some details, throw them out to someone and earn a small commission for referring it. It's really
exactly. It's all right, Mr. Business Owner or Mrs. Business Owner. If this panel of lenders, if this lender won't do it, I've got somebody else who will. It's more of a, I need to put a proposition forward that my panel of lenders are going to all want to be involved in this, rather than, okay, I'm going to take it to this person because they're more likely to accept this. Like, that's not the position you really want to be in.
No, but there's also that element of the market, and depending on the sector or the location, whether it's pay when paid, whether it's RPO debt, different lenders have different approaches to certain types of lending.
Mm-hmm.
But the key thing of all of that is to get the best deal, you really need to understand what the core need in the business is, why it is requiring financing, or why it is requiring to revisit the terms they've already got. Because if they were doing well and achieving what they wanted and they've got a product that's worked for them historically, then why would they look to change? They wouldn't.
No.
And this is usually where there's a trigger of something, either performance has gone backwards, the lenders come to them and gone, we're going to revise the terms because performance has gone backwards. We want to expand overseas, and that's now going to require different capital, which maybe our current provider can't handle. Or generally we feel like we've been paying too much and we want to get out there and look at what else the market can do. The solution to all those things is remarkably different, but comes back to the same thing: is it's the credentials of the business underpinning it that will dictate the likely success. And that's where the difference between that and what's been historically the last 2-3 years, because of COVID and the impact that had, and the amount of government-based back support out there, it was so easy to go and get a big loan to kind of tide you through that period. You didn't have to ask yourself the cold, hard questions that most people are having to answer now, which is, can we support the size of the business and the cost base we've got? And that is where you've got to be brutal.
Well, I think that's about, kind of, again, understanding the finances of the business, isn't it? I think this is probably a really good point. It was sort of a really good time to do a bit of a Q&A session because, again, I was fortunate enough to do accountancy and finance recruitment. So there's certain things that made sense to me when my accountant would mention, like, controlling and sort of budgeting, forecasting, and so on and so forth. But there are a lot of recruitment business owners who unfortunately haven't got that, or recruitment ops people that are in charge of budgets that haven't necessarily got the right understanding of what things are. So can you tell us the difference then between financial accounts and management accounts?
So obviously financial accounts are your end of year statutory process and all the kind of government reporting that goes alongside that, with HMRC and Companies House. Whereas obviously management accounts are what you use to manage the business day in, day out, and where you should be basing kind of your financial decisions upon. But the difference between here's just a P&L and here's a balance sheet versus here's a P&L broken down by department or kind of sector, here's our key KPIs in terms of what really drives value and kind of success in our business is massive. And I think that there's a lot of businesses out there getting into this process of, we have accounts, but they mean nothing. They're just something we do for the sake of it, and we're still very much guided by gut, which works all the time. Business is profitable and successful. The difference between not having the right information when you end up more in a downturn is that the failure to act and act quickly could be terminal. So, and having that understanding of kind of runway, so the difference between how much headroom and cash you've got today versus mapping out the losses you kind of forecast to make, at what point you run out of money, is pivotal. Yeah. Because some people sit there and go, it's what we're comfortable, we've got 12 months runway. But then you break that assumption down and go, well, it's 12 months runway based on your bank continuing to give you £1 million overdraft, as an example. If they took that away, how much runway you've got? I've probably got 3 months. If you've got 3 months, how much time does that give you to really go make a load of cost cuts,
how do you
pay
make
them
a
out,
significant change?
and therefore by that point, you're 3 months into this process, you're pretty much at the stage of where it's not salvageable, or at least salvageable with any real value. You're going to be in a fire sale market where you're going to go to someone that will put some capital in, take the majority of the business, and try and turn it round. Or in the worst case, obviously go into administration and fold. So having that really clear understanding of what your business needs to do week in, week out to survive is massive.
And so how do you... Right, but if I'm a struggling business, recruitment agency, how do I justify then to myself hiring an accountant to do that? Because they're expensive, right?
It depends. I think it's the difference between survival and failure in some cases, isn't it? And it's also that openness to being vulnerable. It's like you go and see a therapist. How long does it sit there before you actually start telling the truth? Because it's that fear. And it's that very much the same. There's a lot
Spoke
of...
like somebody who's been to a few therapists.
but it's that thing of, you go through this process of, there's a lot of ego in the recruitment industry. There's a lot of vanity around, we've got how many offices, we're in this many locations. which is great from a marketing perspective when you're making money or you're trying to onboard clients.
Well, it used to be.
But it's that really that thing of having a massive overhead base isn't appealing.
Yeah.
Because if the market contracts in a big way, and we've seen all these big geopolitical events of we've got obviously the Gaza situation now, we've had Russia and Ukraine, all of which have had a big impact.
If the first half of this year hasn't shown you how fragile our economy is to outside influence and outside external factors.
And then that's before you've also got the US election coming up at the end of the year,
Our
UK
own
election, and kind of wider instability across different parts of Europe. Like, it's a tough time, and if you're not in control of your journey and your kind of destiny, and you're not making changes before you have to make changes, then that's a challenge. Because those businesses that are successful and thrive and kind of go from the beginning of the cycle to the end of the cycle and kind of ride the goods and the kind of the ups and the downs are those that act very quickly. They act decisively. They act based on a plan that they've put together. It's not, okay, we'll lose one person this week, we'll lose another one next week. It's get it done, move on, and you can always go back and rebuild. Not this kind of perennial like drip feeding of kind of cost savings. It needs to be...
You're just doing it for the sake of it, aren't you? And then you just basically just doing it because you've been told to do it, so you're trying to just tick a box. But then that fundamentally comes down to if you know, and you must have this when you go in to support businesses and you give them the cold hard facts. Here's what you need to really be looking at doing. These are the sorts of levels of cost saving that you need to be looking at to survive this. And they're reluctant to, or they're pushing back. You must be able to look at someone and be like, you just don't believe this. You don't believe the information that's in front of you. You still at this point think that, you know, this is salvageable or you're wrong. And I've had this from experience where you're kind of like, party's over, time to go home. Yeah. Or like, you know, and it's like, no, it'll be fine. We just need to. No, it's like the facts say one thing, your opinion and heart and ego and emotion say something else. So what we're gonna follow here, right?
Yeah, and it is that thing is everyone's guilty of it because it is that case of where a lot of recruiters are the eternal optimists of, do you know what, that next big deal is around the corner, we're going to suddenly grow our contractor book by this, and that's great. It's great narrative for great things around the sides, but you're then in a situation where those things don't happen and you've lost the ability to make those changes. Yeah. And there's like this one business that I kind of worked with for like the last 4 or 5 years, and you look at it and it's the same problem every year. But this year is probably the first time they've actually acknowledged it and are now going to take notice, rather than it being, don't worry, it'll be fine, it'll be fine, we'll always get through it. And I think that's...
Because the other metrics were fine.
Yeah.
Directors all got what they needed, staff all got what they needed, the bills all got paid, profits were, okay, maybe they were doing this a bit, you know, but it's fine. I get what you're saying, Scott, but it's fine. Yeah. And then all of a sudden it's like, hang on a minute.
Yeah, and you go, okay, so... Now at the stage where you're taking things a lot more seriously, you do really understand the difference between break even and kind of carrying on losing money. Mm-hmm. And in different sectors that's harder, because you look at education recruitment, obviously you have 13, 14 fallow weeks of where you earn nothing.
No, yeah.
You don't. It's not like you employ your staff 39 weeks a year. Like you employ them 52 weeks a year, and you've got to cover the kind of the shortfalls there for that period of time. And I think that's a big challenge for lots of businesses in that kind of sector. Mm-hmm. And then you've got other kind of sectors of where, or even recruitment businesses of where the information they're looking at is not just poorly prepared, it is just completely inaccurate and kind of based on this philosophy of, it's nice to look at nice numbers, not necessarily the truth. And we've had this on a number of cases recently of where you'll dig into it as kind of what started as an initial funding prospect, and everything that underpins that data is flawed. Mm-hmm. And you've actually got the reality of, rather than a business starting losing money now, it actually started losing money 18 months ago. And that's just kind of the ineptitude of kind of some people in kind of the funding world, because they don't like having difficult conversations. It's far better to kind of survive and do some things than the reality of dealing with the problems as they exist, because no one likes bad news in a tough conversation. Who wants to be that finance person that goes to say to the person who owns the business that if you don't do something, the business can be bust tomorrow, without thinking like, oh shit, like we should have done something there. Yeah. And there's a lot of warning signs that can kind of prevent these things. And you kind of go, actually, okay, we're ticking all these warning signs. Why are we not doing something?
Yeah, you almost don't want to be at a point where you don't want to be looking back at the warning signs and being like,
You don't want to be going back, looking at something, saying, 3 months ago we should have done this.
Yeah.
It's because unless like that is a massive period of time that you've lost, money that you've lost as well,
and potential runway as well, right? Yeah, you can't. You can almost be too late by that point. Yeah.
And that's the massive thing, because a loss-making business is far harder to fund in the best of times, let alone when you've got a very short window of kind of survival.
Mm-hmm.
And the attitude for most of the mainstream banks and kind of a lot of kind of the tier one lenders will be that they won't. That's not where their kind of appetite to play is.
Yeah.
So then you're into a much higher form of kind of cost of capital. And also the question of whether you can access it.
And that comes back to the point around kind of being open and honest, right? Because you're kind of like, look, it's okay if your business is loss-making, provided you've got an explanation for it and a kind of implementable turnaround plan.
Yeah.
But if you can't prove if you can't prove on paper that you can turn this business around, what chance have you got proving to a lender?
Yeah,
especially a lender who's going to look at this properly and send it up to, like you said, a credit committee who are all going to review it, not just a computer that's going to go, yeah, you can have this. Yes, you qualify. Yeah. No, you don't.
Because that's I think you put it really well earlier. Like the process for business lending is so different to personal lending.
Yeah.
Personal lending is credit score based and income based, and it may be some verification of that. Business lending is very much a context of, okay, this is the product you're looking to borrow for. One, does the information support the purpose you're trying to use it? So, invoice finance, is the purpose of this for cash flow funding? Yeah. Okay. Great. Then. Okay, how secure is that invoice book? So is there an audit trail from invoice through to timesheet, through to approval, through to upload, and kind of make sure it will make sense? Okay, yeah, there is. That's part of it. But then if you kind of come back to a lot of these businesses where they're starting to struggle, is because that base level of working capital funding isn't enough to support the kind of the short-term losses. So that's where you're going to a lender and asking for an overdraft or kind of another additional kind of working capital facility, just to kind of buy time to get through the process. And that is far, far harder, because a lot of those lenders won't want to double lend. Like an overdraft's a cash flow product. You've already got an IF facility, that's a cash flow product. Yeah. You're double lending. So really the transparency around why the need for that could be, and then the solution to that is two separate things.
That's the key point, though, isn't it? I think you made a really, really sort of solid point around, which often gets missed, is the point I want to make, which is that after everything, strip it all away, if what you bring in isn't covering or isn't enough to cover what goes out, you have a fundamental issue, right, in your business.
Yeah.
And that's not a lending fix. That's not we need a better line of credit. That's no.
All that does is buy time.
Yeah, you got to put the bonnet up and have a look at what the fuck is actually going on. And as we said, that might mean stripping out a layer of management. That might mean closing down 2 locations, 3 locations. That might mean having to, as a director, take a step back and not take as much money out of the business.
Yeah. Or
perhaps even get on the tools and, do you know what I mean? Like, there's other things there, and actually the answer isn't always, I need to borrow more money. Yeah.
And that's the thing. That's what COVID made very, very easy. Was the fact that there was lots of government schemes there. So the answer was, just use the free or kind of this supported money that's out there. Whereas you now come back through the other side, and it's the attitude and approach to it is one of the massive things of where you could have a CEO or founder that kind of goes, do you know what, actually, I'm coming back into the business full time. I'm not going to sit and rely on a management team. I'm actually going to lead this business and we'll go through this period together. Versus those that go, just find a way to borrow more money.
Yeah.
And that's the thing is, a founder coming back in, rebuilding that business is one thing, but that's usually not likely enough to be enough to kind of reposition it. It's going to follow a big cost cut as well.
That's right.
Because
it's underpinned by that business. But again, this is what comes back to that point of the credit committee are going to be more likely to want to entertain a loss-making business that's saying, founders coming back in and being very hands-on, the following cost-cutting measures are being made. These things have been identified as issues within the business, and these are the steps that we're doing to rectify that. So it's kind of open and honest in terms of, I've looked at the issue and the business, and we've identified where the issues are for us to have ended up in this position.
Yeah.
And now what we need from you is the lending support to help us deliver this. Yeah. That's a lot better than going, oh, what happened to the money? Oh, just hard times. And if we just had another 100 grand, it might make the problem go away. No, we'll keep the doors open for another 3 months.
And that's that thing. You're still in the same problem, same situation. You've got now more debt, more that's got to be supported. And it's it's on a one-directional street, unless the market comes back and in some areas makes that process very, very simple. But that approach to having some skin in the game as well, like if you're sitting there as a founder taking the vast majority of the profit out when it's been really good years, the business had a downturn and you're still taking the same amount of money out of it, that's not going to fly with most lenders.
No.
Because they're not going to lend the business more to carry on supporting your lifestyle and putting unsecured lending in place. Like, there's an expectation that you take some of the pain as well.
Yeah, it's amazing how often that must happen though, as well, right? In terms of like,
I think it's the nature of the industry, though, isn't it? Because it is built like most successful, scalable recruitment businesses are underpinned by a founder that was a biller and kind of thought, I can do it my own way.
People.
And money was the driving force behind that.
Yeah,
maybe we're starting to see that shift a little bit more as there's more people that are adopting the B Corp mentality. Kind of this mentality of where they give back, and it's not just about profit, it's equity for the staff. And we've got more and more companies where they're selling to an employer, kind of an EOT, kind of the employment trust option, instead of where it gives their staff a greater stake and that sort of thing. But their options are all available based on the underlying success of the business. If the business isn't successful, there's very little options that are available depending on the point in time. And probably the worst thing you can do is carry on just looking at the things and kind of that traditional mentality of you just kind of bury your head in the sand and you don't open the mail, you don't think about this, and you just kind of assume the business will be all right.
I think the key is that if you're in a position where you think that you might have a problem, you probably do. And that's where kind of people like yourself are really, really important, because you're relatively straightforward in terms of you're easy to contact. It's not like there's it's not like you're kind of you're not going to get back to people, or you make it difficult to get hold of you and that kind of thing. And you're very, very good at very quickly being able to assess there might be a way out of this, or sorry, pal.
But that's the thing, like the reality of being able to go and look at it and go, okay, straight away, where's the problem here? Because and this is the thing, there's lots of different people who have different approaches to different things, but the fundamentals come back to being the same, which is really, are you profitable? Actually, is that profit right in the first place? Because you've got a profitable business that's struggling for cash flow, that could be real. It could just be the fact of you're not getting paid by your key clients and you have to pay all your contractors and that earlier because you haven't got the right kind of working capital solution. Or that you're in a situation where you can't there's not an available product for that location. You might have opened a new office and you can't get IF in that country, and you're just kind of cash flow funding it that way. So there are kind of those situations, but more and more it's the case of people look at the numbers, they don't understand them, and it's kind of that belief of it will all be all right.
Yeah.
We've always been all right in the past. What's going to have changed now? Why won't we be all right? Rather than the reality of going, okay, do you know what? Most people will take a look at something for nothing and kind of go, do you know what? I'll give you my opinion on whether I think there's something we can do here for free. Like, why wouldn't we? The whole idea of this is you start a kind of a conversation about looking and understanding where value's created. And if you've got a loss-making business that's going to run out of cash, that's not necessarily the worst thing in the world, because it might be salvageable, but it's being in the position to take the medicine to kind of get through it and accept the need to take that rather than fighting it. It's the same as if you're kind of in this kind of similar vein of you're a startup kind of RecTalk product and you're going, okay, we raised money maybe 18 months ago or a year ago at this valuation. We now need to go and raise our second round of funding. And the market from a VC and investment perspective has changed. We've seen all the tech companies in terms of valuations, massive layoffs, and lots of it's been a lot harder to raise capital. And then you're sitting there with a product that's still pre-product in a lot of ways. You've got an MVP, or you've almost got an MVP, but you've got no validation, and you're going out to the market asking for a ridiculous valuation. and it's just not going to fly. Like
No.
there's enough competition for money out there,
Mm-hmm.
and it's already hard enough to kind of raise capital in a good market, that when it gets tougher and it's not well thought through, that's an even bigger problem, because it's just not going to, like, there's so much. But that comes back to the broader problem overall of where there's so much naivety around, because everyone sees the success of, oh, this company's just raised £250,000 to go off and build this or do this, or been on Dragon's Den, got this kind of investment, or and so on and so on. It appears really glamorous, but the difference kind of that kind of route is a startup founder in a tech company. It's not glamorous. It's massively hard work. You're usually working for free. You're kind of on a journey to get to a point of where you might realise some money to carry on living that life, but you're not getting anything out of it until the very end.
Yeah.
And that could be 5-10 years down the line. So it's about really understanding and taking as much advice and experience you can get along the way as possible, because that's where you kind of help yourself on that journey. Whereas so many people bury their heads in the sand, or think they know best, or don't like advice or criticism. And that's where...
It's a human trait though, isn't it? I mean, there's that famous Nokia conference where it's a handful of the senior management team of kind of Nokia kind of take the stage, and they're like, we didn't do anything wrong, but we still lost. You know, when sort of smartphones took over, and you know, and sort of Samsung exploded and Apple exploded and Nokia didn't. And that was their attitude. It was like, well, yeah, we didn't do anything wrong. We did I think the quote was, we did everything right and still we failed. And it's like, that's like that level of like kind of lack of self-reflection or ability to self-reflect is dangerous.
But that's also the difference with companies like Nokia, as you said, versus your Amazons, your Googles, where they all have their venture program. The same with Meta and that as well, is where they will spend billions of pounds, or if not tens of billions of pounds every year failing. Yeah. Because they'd much rather try something and fail than not try it in the first place.
Yeah, than not be involved in.
That's the thing. Like if the iPhone
Google
never
Plus,
come along,
great kind of example. There's that Google Plus, Metaverse. Facebook seems to have pulled back out the sort of the Metaverse project. But all these things take kind of that risk.
They're all punts. It's that thing, isn't it? And it's kind of the same as what a VC, the traditional VC landscape is. Yeah. They'll invest into 100 companies, and knowing that probably a handful will come off and pay for the 95 that fail. Yeah. Because that's the methodology of where the difference between success and failure is. Failure's down here, but success could be 95, 100x times on what they've invested. So as long as that's the criteria, it all kind of makes sense. But the difference between success and failure is massive. There's so many avenues of where a little tweak here, a little tweak there, listening to people who know and kind of using feedback and advice, and there's lots of methodologies and different things out there that kind of push those traits.
Well, we spoke about this literally this morning, didn't we? Exactly that. The ship, kind of steering the ship mentality. You know, just a minor variation of sort of 1 or 2 degrees to the left can make your destination go from here to here, right? Over that journey. So
well, it's the classic Titanic situation with the iceberg. Yeah. And there were so many warning signs there before that could have avoided that. And yet when you look back at it, it's kind of, they chose not to act. They went against the advice. They then weren't concentrating, and then it's like, oh, actually now we need to do it. And even though they took action probably very close to what might have been the last possible moment, they still ended up, obviously, with the tragedy they ended up with. And that's so typical of business. There's lots of little warning signs on the journey, and that really could be your KPIs. Like, if it's a weekly driven business, how many runners do you need out each week? Where are you against your run rate? What does that mean in terms of break even? Are you on track? Are you not? Are your customers paying on time? Are they not? Like, what is going on with your working capital cycle to kind of drive that? And unless you really understand that, which is really coming back to the basics of what goes in and what comes out, which naturally is any business. This is what we're going to invoice. That's what our cost base is. And therefore, if you never really understand what your actual cost base is and what that theoretical break-even point is, then how can you ever know?
What are you working towards then? Yeah. Just literally plugging figures in, aren't you?
Yeah, and it's not just, oh, we wrote loads of new business next month, like this month, so it's great, but most new business recognises a contract as 12 months revenue, and that's not going to get you through this, over a compound period of time. Yeah, great. But the here and now is the difference between like survival and failure.
Mm-hmm. Mm-hmm.
And that is going to be something that hits the sector very, very hard, because it has become unsustainable in a lot of cases. There are companies that invested so much in kind of growing and scaling because there was suddenly this massive kind of upward kind of hiring curve, and now kind of coming back down the other side of it, it's, okay, we're over leveraged, overexposed.
Yeah, what
market conditions are harder, and we've got this massive cost base. The reality is that cost base needs to shrink.
Mm-hmm.
Because at least by taking decisive action in one go, you can then go back and rebuild.
Okay.
If you kind of just a little bit here, a little bit there, it's just, in most cases, obviously there are exceptions to every norm of where like you might have an amazing month the next month and everything will suddenly turn around. But those kind of cases are few and far between.
You can't run a business on an if but and a maybe like that. You just can't, right? You might have this, okay. You might do, but you also might not. And that's not a great place to be.
No.
You know, again, from experience, I've been there, right? We just need this month and next month to come off and we'll be all right. That's not a small ask.
No.
You know, I just need a record-breaking month.
Every month.
I just need 6 numbers in a row, and I'll be rich. You know what I mean? Like, that's all I need. Why can't I guess 6 numbers in a row? That's all I need. But it's also the same mentality. But
it's also that mentality of having to make hard decisions no one likes.
Yeah.
Because naturally, okay, you have to take people out of the office. Okay, maybe you've got to move to a smaller office. Maybe you lose some of the plugins and tools you've got. And do you know what? The recruiters generally have to work harder. Mm-hmm. Because something this luxury life they've had of maybe someone doing part of the process for them. They've maybe got an offshore delivery team that feed them. And you go, actually, we can't afford that anymore. Mm-hmm. We can't afford that anymore. And go back to a situation where you've actually got to work and drive compared to, I hope you're right, we'll do more business and things can stay as they are. It just doesn't work in reality. No. And
we'll just bill more doesn't work. That's just this. Yeah. You're not going to sit there. We'll just put more goals in. Yeah. Well, that's my fix. What's your solution to this bad season you've had? You know, Man United boss. Oh, just score more goals. Oh, is that it then? Oh, wicked.
And it's like, but Man United is a great example, isn't it, of kind of something where performance has kind of continually gone back. It may have gone up, but every time the answer has been to kind of change the manager.
Yeah.
Rather than look at the root and branch setup of the kind of
what
infrastructure.
Are we doing? Yeah.
And that's the thing.
But they're not listening to some of the cold hard truths that come in as well. It's a really good example, because then you had like Ronaldo come in and he was like, I was here 12 years ago. The catering facilities are still the same. The training facilities are still the same. Staff are eating cake at, when they should be, focusing on nutrition. They're not. And so the guy was telling you cold hard truths. You don't want to hear it. Yeah. So you ban no stim as well. You get out as well.
And the equivalent of Ronaldo coming back is your founder or your kind of CEO come back into the business. Yeah. Trying to bring that superstar kind of biller back in to kind of get on the tour.
Let's just get back to basics.
Rather than taking the cold line back out from an external view and going, well, it's crumbling here, it's crumbling there, like there's no investment in infrastructure or this, and what have you got to do? You've kind of got to rebuild from the ground up, and that's a massive overhaul. And that's the thing of, to make a big overhaul in business, you also need time, because every time you change something, you've also got the risk it could go the wrong way.
Yeah.
And having the kind of the comfort and funding to do that is massive. If you make changes, it doesn't work in the way you do because maybe you have a few other people leave or something else happens, and you're literally there, I've only got 1 month to do this and make it work. That's far harder than going, do you know what, we've got 6 months runway, we're going to start this plan today, this is what's going to happen in the next 3 months, and then coming out the other side, we'll kind of go back on the other journey.
But the key to that is then having the right sort of financial controls in place, understanding the difference between financial and management accounting, and the importance of budgeting and forecasting to be able to have that 6 months runway to be able to go, something's not right here. Yeah. We're heading in the wrong direction. We now need to start making changes, rather than being 6 weeks away from the end. You know what I mean?
And the thing of it, businesses fail very, very quickly. From the point of where they think they're salvageable to when they fail, it can happen very, very quickly.
Very quick, yeah.
And I think that the reality there is, it is just that reluctance or lack of wanting to make change.
Yeah.
Because it's saving face. I don't want to be the recruitment business owner that scaled back massively. Like, I don't want to cut 2 offices because I like the idea of having presence in the States. But all of those things come back to, if you've got the basic kind of well thought through business processes at heart, then it's far more scalable and salvageable.
Mm-hmm.
Like, there are still so many recruitment businesses today that won't have a cash flow forecast.
Yeah.
Because they're contract recruitment businesses, they've got invoice finance, and they just look at the available headroom every day or every week
Get
and
the
go,
GP and go, yeah.
and that's
We'll
it. And they know, okay, as long as we pay this, we're fine.
Yeah.
But that's fine in kind of, again, glory days of where you're making money and you kind of, that sort of thing. Take it back a notch of where the market maybe not performing quite the way it was. That tells you nothing about how much time you've got.
Yeah.
And you never know, like, if it's a non-core kind of offering, of when a lender might go, actually, we can't support you anymore.
Mm.
And that happens like that. That's kind of a clear fact. But yeah, it is hard. And making those decisions where you have to lose your team that you kind of brought in to kind of go on this journey, and then you're saying maybe a year later that, okay, we can't afford you.
This didn't work, yeah.
And that requires, like, there's some self-reflection there, or kind of acceptance of, we all make mistakes.
Yeah, yeah. But again, it's damn sight better than having a conversation of, you're all out of work.
Yeah. And that's the thing, is it's, would you rather have a business that has 500 or 600 staff and goes bust, or one that survives with 100 staff?
Mm-hmm.
Naturally, you have to take your if the business has got to that stage, you have to know, based on where you are today, of how much you've got to take out to get to that point where it's kind of like salvageable.
Yeah.
If you delay on that and it's kind of a very long drawn out process, then
that point gets further and further into a situation where it's not worth salvaging.
No.
Yeah.
And then that's a
yeah,
far...
Yeah.
And there is all those situations of where these things can be avoided. But yeah, it's tough. Like, it's not the easiest market in the moment to make money out of.
No.
And like, I don't think it's massively going to change in the short term. I think there's a lot more pain still to come through this year.
Sadly, I agree. I think we in the recruitment world tend to be very, very optimistic for quite often the wrong reasons, and there is this level of optimism that no, things are going to turn around. You know, tough first quarter, let's hit the second one, and this, that, and the other, and it's sort of like fundamentally nothing's changed. You know, like economically, if you think of the like pest or your pestle analysis, none of those things have changed. If anything, some could argue they've worsened since the start of this year. So what makes you so optimistic that things are going to get better? Blind optimism, right?
Yeah.
Because those who are doing the proper forecasting and the proper like kind of controlling of their business will be able to see that shit, actually not much is changing here. We need to maybe either buckle down or we need to continue down this cost saving route that we're going on.
Yeah, I mean, it's also that thing is that there's more and more speculation about interest rates being reduced because inflation's down to 3%. But if you go back to the mandate of the Bank of England, it's that inflation should be at less than 2%.
Yeah.
So there's probably still a little bit more pain in the cycle to come before interest rates do start to fall. Mm-hmm. But again, that could be the false optimism. I think, do you know, we're on that journey. We'll start to make it easier now because, you know what, the trail will follow and it will be fine. Whereas I think there's less and less reluctance to do that now. I'd much rather riding it out until it does go below 2% before they go, actually, we will change it. Mm-hmm. Mm-hmm. And I think that
at which point there might be a new government in place. And their focus might be something different. And there's so many different things and variables involved in this. It's sort of like you can't do it on a wing and a prayer. You've got to think about kind of, right, worst case scenario, how do I weather the storm in the worst situation so that even if the situation's better or slightly better, I'm coming out, good on the other end.
Yeah, and like I say, it comes back to that basics of regardless of the market conditions, you should have the right process in place. If you're making money and great, you should understand why and how you're making money. If you're losing money, you should understand where and why. It's the same logic of if you don't understand those basics, then regardless of the situation, you can miss them there. And having the right advice and the right support is key to going through that process. And yeah, it makes you feel vulnerable because you're going to get open criticism from someone who doesn't know you and doesn't want to pander your egos for a certain degree. But the difference between having someone else say it to you and you thinking it and doing nothing is massive.
Yeah.
At least then there's a conversation. It's, okay, this is what we've got to do. This is how it can be fixed. These are your problems. If you don't know what your problem is and what's going wrong, then how can you fix it? It's if you can't see the end of the tunnel because there's something in front of you, then you're always going to have that blinkered vision. Whereas if you go, okay, we're approaching this point of no return, but do you know what? There's these ways to get out of that path or that journey, then that's far more valuable. Like, it's just crazy.
No, that's a really, really fair point, isn't it? So how do people reach out to you then to have that kind of no punches pulled, no ego stroked answer of
LinkedIn?
Just a business. So what's your process? Will you do a business assessment with them? What can they expect?
So the way we'll traditionally work is that we'll look at any prospect, kind of an initial kind of overview of what they're looking to do, where they're at, understand some headline kind of financials. And at that point, it'll be obvious, is it just you need a different lender for a product, or there's some different capital available, really high level, compared to, okay, the information here presents a lot more questions than answers, and then for us to go through that journey and that process, we need to go back and understand kind of how you get here. Like, is this number, are these really the right numbers? Is it really sustainable? Or what is really the need for the cash, because your logic and your rationale don't necessarily match what you're saying. But yeah, like LinkedIn, email, like really simple. And like I said, we'll always do the first kind of review of something for free anyway. And then we'll understand, is it something we can help with? If it's something I don't think I can help with, there's no, I'll be honest and transparent about that. If it is, then we'll work out how we can do that. And we work in a way where we don't necessarily prioritise kind of short-term kind of relationships. It's really how can we help and support people, and the second bit is kind of coming out of a commercial arrangement that works. Yeah, what do you do on the other end? Yeah. Because besides kind of lending products, we work with different kind of founders that are looking to raise investment in tech products or recruitment tech products, and most people looking for funding know that there's not a lot of money around at that point, so you have to take a view on, is it something I can help with? If I can, then the likelihood is it's going to be an equity kind of journey rather than just, here's a fee for helping with something. So it's also about being transparent of what can we do and being flexible. Okay. Yeah.
No, good. No, I appreciate that. All right, this has been full on, but yeah. But no, it's been insightful, really insightful. I'm glad we did this.
Yeah.
So, cool. Right, well, that was another episode of RecTalk. And don't forget to like, subscribe, follow. Thank you for all of the follows on YouTube and our LinkedIn channel so far. And until next time, thank you. That's it. We're cut.
Cheers, mate.
That's it, mate.
That's fucking crazy when you think about it, isn't it?